Hey folks, so this is going to be a video about Globus, about how do you evaluate your results that come out after the decisions. I'm going to record at least three videos today, one about evaluating the results, one about implementing a cost leadership strategy, and one about integrating a differentiation strategy. So I'm going to start with this: how do you understand where you are? You need to do what I call a post-mortem on your decisions, and I guess maybe a post-mortem is appropriate for some of you because post-mortem is what you do after something's dead, right? But what I mean by that is you need to go in and you need to review your results. Ask yourself, first question that you need to ask yourself is, what was my intended strategy? Okay? And you should remember what your intended strategy was. Second question, what was my actual strategy? What I mean by that is, just because I intended to be the differentiated provider for company G, or just because I intended to be the cost leader for company H, there's no guarantee that I actually achieved my competitive position that I was trying for, okay? So the third question is, remember, what was my intended strategy? What was my actual strategy, or did I get the strategy I wanted? Number three is, did I achieve expected results? And number four, if not, what do I do about it? Okay. So looking at, this is the camera and drone journal, which is available to you in Globus. The first page that you'll come up to is the scoreboard for the year and game to date. So obviously, since we're in just year 6 now, we've only had one decision round. The game to date is going to be the same, okay? So that's the first page. It gives you the results. The scores, which I'll go through how they're compiled, will be revealed here, okay? The second page gives you your results with regards to earnings per share, return on equity, and stock price, okay? So we'll start with earnings per share. For the simulation, for the entire simulation, after we get past the practice rounds, earnings per share are calculated each year, okay? For the year, you're trying to get the best in industry. You're trying to meet the investors' expectations. Game to date, the earnings per share have a weighted average for every year, okay? So 20% of your score is for earnings per share. As you can see here for company G, the yellow highlight for company G means that that was the best in the industry. So you see year 6 score, best in industry. I got 24 points for that. Or excuse me, investor expectations, 24 points for that. Best in industry, 20 points for that. Those are the max points that you can earn. 24 if you beat the investors' expectations, and I beat them pretty soundly, right? So the more you beat them, the higher your score. For instance, if you look at Team A, investors' expectations were $1.25. And Team A got $1.42, so they got 21 points. Team B, $1.47, they got 22 points. And then you're ranked for best in industry, okay? So year 6, the year 6 score and game to date score are the same, but that's because it's only 1 year, okay? Remember, earnings per share are weighted average, okay? Return on equity is also a weighted average. Investors' expectation for year 6 was 17.5%. I was company G in this particular explanation, so I'm top in the industry, again indicated by the yellow highlight. I earned 24 points for beating the investors' expectation so handily, and 20 points for best in industry. Stock price, the investors' expectation was that your stock would go from $12 at the end of year 5 to $20. And as you can see, my stock price went up to $102.10. So as you would expect, I got the investors' expectations and best in industry. A word about stock price. It's different than EPS and ROE. Your stock price, your game-to-date scores are only based on the most recent year's stock price, okay? So your stock price could really be in the toilet for year 6, 7, 8, and 9, but if you pull it out in year 13, then you could actually win the best in industry and meet the investors' expectations and have really high scores there, okay? Team D, You don't want your stock price to go down, okay? You never, ever, ever, ever in a million years want your stock price to go down, okay? Next page is credit rating, okay? They're like the stock price. The last year is the year that your stock price, or excuse me, that your credit rating counts. Investors' expectation was a B+. If you meet the investors' expectations, you get 20. And then pretty much everybody had met the investors' expectations or had the best in industry. So those points are allocated. Your year 6 score and your game-to-date score will be the same, okay? Image rating, investors expect that you should have an image rating of 70 points. Team G had a 76. Now, I'm going to go ahead and foreshadow what I was going to tell you when I get into the breaking down the individual strategies. Team G was running a differentiation strategy, which is going to typically be less market share than a cost leadership strategy. Team H is running the cost leadership strategy, and as expected, with the biggest market share, they've got the highest image rating, okay? Your image rating is based on the most recent 3 years. It's an average, okay? So since we've only got 1 year, year 6 and game to date are the same. Since image rating is largely a function of market share, corporate social responsibility is another way that you can earn image rating is by doing good things in the industry, okay? You have the opportunity to earn bonus points. If you meet your expectations plus or minus 5%, and for your image plus or minus 4 points, then you get what's called the Bullseye Award. That's for accuracy in your forecast, okay? So as you can see, Team G, I was only 1.7% off on my revenue forecast and 2.8% off on my earnings per share forecast. And I only varied by 1 point from my image rating. Okay, so in year 6, I did get the Bullseye Award. However, looking at Company H, I did not get the Bullseye Award because I was 5% off and 11.3% off, respectively. Okay, after year 6 is over, you can earn the Leapfrog Award. Starting in year 7, the company that makes the biggest jump in their overall score earns a Leapfrog Award. That's for the most score change, the most positive change in score year over year. Okay, next page, page 4, is the industry overview. It tells us what happened to the average price, tells us what happened with demand, and it shows us what the price and PQ rating did. So price went up from 225 to 242. That's the blue bar in this, or blue line in this line graph. PQ rating went up from 4 to 4.3 in the industry, and the number of features in the camera went up from 3 to 3.5. Okay, so demand was a little bit higher than forecast. Okay, it was 0.3% higher than forecast. It was up by 7.4% from year 5. Okay, it's expected next year to increase by about 7%. For the drone, the average wholesale price was up by 6%. Demand was 3% lower than forecast, but it was still up overall. The total number shipped was up by 16.4% from year 5. There's adequate assembly capacity. Demand for drones is expected to increase by about 14.3% from year 6 to year 7. So you see average price went from $10.75 to $11.39. The number of features went from 5 to 5.1. The PQ rating went from 4 to 4.3. Okay, so that's what the industry is doing. For financial statistics, this gives you financial performance summary not only for your company, but also for all of your competitors. Okay, so you can compare your revenue to your competitors' revenues. And as you see, with $481,738,000 worth of revenue, Team G was the biggest company in terms of sales, not the biggest in terms of units, but in terms of sales. And again, that was because I was running a differentiation strategy. Ran away with the profit numbers as well, 61 million in net profit. Okay, for the balance sheet data, you can take some clues here by looking at total assets. That'll tell you how much people have in fixed assets. So it gives you cash, total current assets, fixed assets, and total assets. Remember, there's very little inventory that you'll actually be carrying, okay, because you're producing just in time. So essentially, current assets is a little bit of accounts receivable, all your cash on hand, and a little bit of work in process inventory. Shareholder equity tells you your stock sales or purchases. I'm glad to see that 3 out of the 6 teams did purchase back stock. In general, you will only buy back stock every time you can, okay? Debt is always cheaper than equity. Equity is reflected in stock. Debt is reflected in interest expense. So you always want to buy back stock when you can. I'll talk more about ending equity as we get closer to the end of the simulation, but this number always has to remain above $100 million, okay? Then you've got selected financial and operating statistics. Remember, there's 2 ways that your owners get paid. The first is dividends. So this is giving you your dividend payout ratio as a percentage of net profit. The second way that your shareholders get paid is by capital gains when they sell your stock. You don't want them selling your stock, right? You want them to buy it and hold it. You want that stock to appreciate, okay? So if your stock's going up in value, your shareholders really aren't getting paid right now. They've got a paper gain, but nothing really paid right now, okay? All right, page 6 gives us the camera benchmarks. As you would expect, I've got a relatively high cost to produce the camera. Given that I was the differentiated provider in the industry, which I'll talk about more in a bit, you would expect that I might have the highest production cost, but the highest production cost in the industry are actually $166.74. My production costs were about $4.50 less than that, okay? This gives you your operating benchmarks, delivery costs, marketing cost, operating profit margin. As you see, in North America, I had the highest operating profit margin. Europe, Africa, highest operating profit margin. Asia Pacific, the highest operating profit margin. And Latin America, the highest operating profit margin. Folks, that's exactly what you would want to have if you're running a differentiation strategy, okay? Looking at the drone, I am the most expensive to produce here, okay, as you might expect, since I'm the differentiated provider. Okay, scrolling down, I don't have the highest operating profit in North America, but it's within $10. I'm highest in Europe, Africa. I'm above average, but not the highest in Asia Pacific. And my operating profit is really, really low in Latin America. There's a very good reason for that, and it's that I raised the prices, demand dropped, okay, and I increased my marketing expenditures. If you'll notice, my marketing expenditures across the board pretty much are the highest in the industry except North America and Europe, Africa, okay? So there you go. That is the debrief on the camera and drone journal. There's much more stuff that you can dig in, but I'm not going to hold your hand and lead you through it, okay? Y'all start making some decisions.